Well, hello everyone, and welcome to today's Wilson Pateras presentation. It's our last presentation for 2020, so thank you all for attending today. We're blessed to have with us today Roger Montgomery from Montgomery Investment Management to talk more about the next year coming. So particularly for all of us here in Melbourne, a lot of our clients who are based in Victoria, 2020 has proved to be an incredibly interesting year for quite a number of reasons, of course, which are all very well documented so far, and particularly from an investment perspective. So there's been a few ups and downs and quite a bit of a roller coaster ride when it comes to how we deal with our money and finances. So we thought it would be perfect for the final presentation of the year to have Roger come on board and talk more about how things may look into the future. A little bit of housekeeping for today. This presentation will go for roughly 45 minutes to an hour. We're more than happy for you to put forward your questions throughout the presentation. You'll notice there is a Q&A box and a chat box within your Zoom functionality there. So feel free to put forward your questions. I'll do as best as possible as host to try and help to have Roger perhaps answer some of your questions as they come up throughout the presentation, but we'll also have time available to end for those questions. So I guess in respect to Roger, it doesn't need much introduction. Roger's has done some presentations for our clients in the past, which we're very thankful for. But yeah, Roger's very well known in the investment world. Has done many and continues to do many, much in the media around various types of things to do with money. So to that end, I'll throw across to you, Roger, to do today's presentation. So thank you, Roger.
Thank you very much, and thank you, Nick and Christine, for putting all the technology together to make this happen. I'm looking forward to presenting to you over the next 45 minutes and to answering your questions. I'll do my best to answer them as we go because I don't want you to forget the questions by the end of the presentation. Firstly, I just need to mention that I'm going to be talking about stocks. I'm going to be talking about the market. It's really important to understand that we don't take into your account your investment objectives. We don't know your financial needs or circumstances. And nothing that I say is a recommendation. I might say that I like a stock. I might say that I don't like a stock. It doesn't mean I'm telling you to go out or suggesting you go out and buy it or sell it. Okay, so in terms of the agenda today, we're going to very quickly look at an overview of one of our funds and its performance or our business, overview of the business and the performance of the fund. Then I'm going to ask the question about whether or not we're in a bubble and address using three different, very popular and common tools, I guess, for deciding whether or not we're in a bubble. Oh, someone's got their speaker turned on there, so you might want to turn that off. And then we'll look at various themes and how to navigate the next 12 months. I personally, look, I'll tell you at the outset, I think we're in for a really good year over the next 12 months. That's one of the reasons why in our funds we're down to historically low levels of cash. I'll explain why I think that's the case. And I'll also talk about some of the themes within that sort of fairly bullish or optimistic scenario that I think you could take advantage of. And then if we get time, we'll talk a little bit about the longer term end game for central banks and governments and what that might mean for markets as well. Okay, in terms of the team, we've got a concentrated team of highly skilled professionals with a lot of experience. In the last 12 months, we've added two small cap specialists who run the Montgomery Small Companies Fund, and that's Gary Rollo and Dominic Rose. They meet with they probably hold 300 to 400 meetings a year with the management of small companies, sometimes the same companies multiple times. And so their understanding of that small cap space and of management teams who are very good helps them to discern opportunities in companies that might be pre-profit or even pre-revenue. So where a good management team have built a business before in the same space and sold it for many billions of dollars and are then parlaying that money into a new venture, Gary and Dom's experience with that management team allow them to actually back the people even though the business might be very early stage. In terms of the philosophy of our business, Pretty straightforward. We've got a bottom-up, quality, value-driven style. So what that means is we're just focusing on high-quality businesses in our organisation. We want businesses that can compound their equity. They can grow their equity at an attractive rate. And to be able to do that for a consistent period of time means that they usually have to have a competitive advantage of some description. We also want a business with bright prospects, and we want to be able to buy it at a rational price. Now, there's a variety of ways that we can determine what that rational price is, but really we don't want to be paying super expensive prices for things that we think are good, even for things that we think are high quality, because we know that the return we're going to receive is simply the inverse of the price that we pay. The higher the price we pay, the lower the return's going to be. And our objective is to outperform the ASX 300 accumulation index over a long period of time. In terms of our small companies fund, which is the newest fund that we've got, I'm really proud to say that it's only early days. We've only been going for about 14 months so far. But I will say that it's one of the top performing, if not the top performing small companies fund since its inception date. And I'm really pleased with the way Gary and Dom are running that fund. In terms of the profile of returns, I'm super proud of the fact that they're, in any month where the market goes up, they're capturing about 122% of that upside movement and only about 80% of the downside movement when a market falls in any month. Now, of course, there's only been 14 months to measure this over, so this will move around quite a bit over time, but the early results are very good, and it tells me, it's a testament, I guess, to the philosophy that we hold at Montgomery to focus on quality, to focus on prospects, and to focus on value.
Roger, a quick question.
Yeah, sure, Nick.
Did the last 12 months present any unique challenges? I mean, a small companies fund, in the current environment, was there anything in particular that meant that it was more challenging for that particular sector?
Oh, of course, the small companies are traditionally seen as less liquid, and so the sell-off in March from the COVID outbreak was something that obviously would be a challenge to all small cap managers. What I'm pleased about is prior to that sell-off in late February, we moved in the small companies fund to about 40% cash.
Yep.
And the reason for that was we could actually see that the death rate and the infection rate, which is what everyone else was looking at, was no different to what everyone else was looking at. But what we were studying really closely that it appeared no one else was really interested in was the testing rate. So the amount of testing being done. So in February, we could see the virus had broken out into South Korea. We could see that it had broken out into Italy. And what we could also see was that in February, if my memory serves me correctly, in January, the United States, now remember they've got a population of about 335 million people. Yeah. The United States was testing 42 people per day for the virus. Yeah. 42 out of 335 million people. And then in February, they ramped up their testing to 90 people a day on average.
Okay.
And so what we realized was that there was going to be a really big problem in the United States for two reasons. Number one is when they started really testing seriously, they would find high infection rates because number two, they weren't testing and they were allowing the virus to spread.
Yeah.
And so we knew that the US was going to be Italy, which was a basket case, was going to be Italy on a massive scale. And so we moved to 40% cash in the small companies fund, about 32 or 33% cash in the Montgomery fund. And then in March, the small companies fund doesn't have a cash mandate. It's supposed to be fully invested most of the time.
Yes. And
so once the market sold off around the middle of March, towards the end of March, around the 24th of March, the small cap guys went all in pretty much, back to 10% cash.
Which was about the bottom of the market in the US anyway.
Well, coincidentally, it was a day after the bottom, but we didn't know it was going to be the bottom. And in the Montgomery fund, we've taken a more gentle approach to reinvesting the money. We're now down to about 8% cash in the Montgomery fund, but that's taken another 6 months to get there.
Yeah.
Whereas in the small companies fund, because it's supposed to be fully invested most of the time, they just went all in.
Yep.
Yeah. So yeah, it did present some challenges this year. Look, the challenges are minor on the scale of things. You know, no one in our office fell ill. No one was infected. We all worked from home pretty seamlessly. So that there were bigger challenges for the world than the performance of our funds. But yeah, I'm happy that we navigated it well. Okay. Now, the question on everyone's mind at the moment is, are we in a bubble? I'm asked this question by the media pretty much every day. In fact, today, you know, I've got all of those media engagements. There's a lot of people who are, you know, asking me to comment in the press and on TV and radio about whether or not we're in a bubble. So I want to give you guys the benefit of my thinking on this subject. So the first thing that you can see is a chart here. And this chart is a chart of what's called the Cape-Shiller ratio. CAPE stands for cyclically adjusted PE ratio. So it's a price to earnings multiple. And in this case, it's on the S&P 500. And it's cyclically adjusted, which basically means that the earnings are inflation adjusted before the S&P is compared to those earnings. And it uses a 10-year average earnings number. Now, what it's showing is that it's at a PE, the S&P 500 is trading on a Cape-Shiller PE ratio of almost 33 times. Now, to put that in perspective, you've got to go all the way back to 1870, and you still only find one occasion where it was significantly higher than it is today, and that's in 1999 during the tech bubble, before the tech bubble burst. And many of you will remember the tech wreck as vividly as I do. So that suggests that the market valuation is stretched. Of course, what's happened is interest rates have come down a lot, and so perhaps while it's expensive compared to the past, the multiple is perhaps more justifiable because the alternative, what we call TINA, there is no alternative. The alternative is terrible, and that is punitive rates on cash. And so it is the second highest ever. Importantly, this ratio doesn't predict a crash. And in fact, Robert Shiller, who's the Nobel laureate who invented this particular ratio, he says, look, it's no good at predicting a crash. It's not going to tell you what the market's going to do next. He does say, though, it is very good at predicting the next 10 years return. So the higher the ratio is, the lower the future return's going to be over 10 years. And so the current ratio actually implies, on this chart here in the green line, you can see it implies a return of about 1.6% per annum for the next 10 years from the S&P 500 index. Now, you might wonder whether or not that's reasonable. It was interesting. I was very, very optimistic about the market for the next few years, as recently as yesterday. And yet overnight, what happened, there were two things that happened. Number one, we've seen a bipartisan group of congressmen and women in the United States launch a suit. So they're suing Facebook for antitrust behaviour. So anti-competitive, what we would call in Australia, anti-competitive behaviour. That's the first thing. And then when Joe Biden was elected, we had a great outcome, or what was perceived as a great outcome. So Joe Biden was elected, which is great because it's better for democracy than Donald Trump. Another 4 years of Donald Trump. Like him, love him or hate him, none of the democratic Western world leaders thought he was good for democracy. And so Joe Biden would be better for democracy. But we also had a split Congress. So consequently, that meant that the left-wing sort of socialist agenda that comes with Biden in terms of taxing corporates wasn't going to be going through anytime soon. And so that really was a Goldilocks scenario for the stock market. The stock market was very excited about that combination, and that's why it rallied pretty hard. But what happened overnight was that there was an announcement by Joe Biden's son that there is now the Attorney General's office in the US is investigating corporate taxes. So this may be a plan to circumvent Congress circumvent Congress and see whether or not they could actually reform taxes in the US, particularly corporate taxes. So that could be a bit of a negative. So I'm still very enthusiastic for the next 12 months, but further out, the combination of an antitrust movement against big technology companies could have a domino effect, and tax on large corporates could also be a negative. So we'll just keep those caveats in mind. It could help to explain, by the way, why over the next 10 years, a 1.6% return from the S&P 500 might in fact be reasonable. Another ratio to suggest that the market is in a bubble is this particular ratio here, which was first discussed by Warren Buffett in the 80s. And he famously elaborated on it in a speech at the Sun Valley Conference in the US, which is a conference held by a company called Allen & Co. Allen & Co. are consultants to the technology and media industry and private equity investors. And it really is, the Sun Valley Conference is basically a conference for US billionaires. And so media titans go, the tech entrepreneurs go, Bill Gates goes, and Warren Buffett presented in 1999. And one of the slides that he presented on was talking about the market capitalization of the US. So looking at all the stocks in the US, their market cap, and then comparing that market value to economic growth. And what he basically pointed out was that whenever the growth exceeds, or whenever the size of the market, because it's grown, exceeds the size of the economy, that suggests that the market is going to produce low returns, and it might even correct. And in 1999, you could hear, when he gave that particular speech, you could hear a pin drop in the room, and all these billionaires thought he was on drugs because he was talking about the market giving a single-digit return over the next 10 years. And remember, this was in November 1999, when the conference was held. And so the market was really on a tear. Tech stocks were, the NASDAQ, and I remember it because I was there at the time, the NASDAQ, an IPO on the NASDAQ, the average first day premium for an IPO on the NASDAQ was 90%, 90%. And so, it really was money for jam just to buy technology, and you just made a lot of money. They just went up. But Buffett was there saying, no, this is not right. It's going to correct. And so this ratio became quite famous. And then later on in 2000, I think it was 2007 or 2008, he again said that the market cap was too high compared to the size of the economy, that it should correct. And then, of course, we had the GFC. And then in about 2010, 2009, actually, I think it was June 2009, he came out and said, well, the market cap is so much lower than the economy, the size of the economy, it's cheap and you should buy it. So after making three really, really prescient calls using this particular ratio, it became quite popular. It says at the moment the market is expensive, and it says that it should correct. But what you'll also notice is that it's been saying the market is expensive since about 2014. And so, by the way, the chart on the left compares the GDP, or the size of the market, the economy, to the market cap of all US stocks. And then on the right-hand side, the chart is the difference between those two lines. And what you can see is that since 2014, the ratio has been growing. So had you listened to this particular ratio and sold stocks back in 2014, 2015, when it was first expensive, you've missed out on a lot of gains in the market.
Roger, there's an old saying that says, this time it's different, or something along those lines, whenever there's a bull market. To what extent is there structural changes in the way that businesses operate or their obligations that could justify the argument to say it's not a bear market? Like, for instance, just in a very anecdotal evidence, we run a business here that services SMEs, and what I've seen through this most recent period is there's so much more cooperation from banks, from landlords, and all these sort of other entities to support people through difficult times, or entities through difficult times. To what extent do those sort of issues or those factors support an argument to say that there's not a bear market for these types of businesses?
Yeah, look, I could give you the arguments for why there's not, and I will in just a second. I'll give you one argument, one I guess salient point. The market could crash tomorrow. I don't know, but I think what you've got to remember is that, and this sort of ties back to the point I made about Facebook being sued for antitrust or anti-competitive behaviour. If you imagine the economy and all the income that we receive from the economy as a piece of pizza, one slice is corporate profits, another slice is social security or social payments, social benefit payments, and another slice is salaries and wages. Well, what's been happening since the GFC is the piece of pizza that represents corporate profits has continued to get bigger every year at the expense of the other pieces of pizza. And historically, and that explains why we've been in a bull market and why right now might be different. But if we take a step back, historically, what's happened is that the pendulum eventually swings the other way. So when the pie gets too big for corporate profits, citizens elect a left-leaning government, a more socialist type government, and they start taxing the corporates, and the piece of pie that represents corporate profits goes down again. And so that, you see that time and time again, that pendulum swinging from one extreme to another. And what's happened is the pendulum at the moment is locked into corporate profits being the largest piece of pie in that pizza. So that explains the difference. And you mentioned the banks being more cooperative with small business. They're also much more cooperative with mortgage borrowers as well. Yes. And so you might remember, we've just had the deepest recession since the 1930s. And did you see any forced selling of property? Yeah. No, you didn't. Why? Because the banks gave everyone a holiday. They didn't have to pay their mortgages.
And if anything, we're seeing here in Melbourne in particular, it's a very buoyant property market as a result.
Look, the one driver, the most important driver for property prices in Australia in the short and medium term is credit availability. So the fact that the federal government has said we're going to relax the responsible lending laws and allow banks to lend more money, that is going to make the banks will start throwing money around for mortgages like confetti, and the property market will boom. There's no doubt about that. When I borrowed for a property years ago, I was able to borrow 110% of the loan. I borrowed for the house, and I borrowed for the stamp duty as well. And the bank had no problem. But then last year and the year before, you couldn't buy property with less than a 30% deposit. And that was certainly true earlier this year as well. The banks were scared to lend. Now that the responsible lending laws are likely to be relaxed, and they haven't been yet, it hasn't gone through, but now that they're likely to be relaxed, the banks are going to step on that accelerator and start lending again, because more of the responsibility for borrowing is borne by the borrower. It's not the bank's fault. They can't be sued for, giving people loans that couldn't afford to pay it. So that's the biggest driver. So look, I think the outlook for the banks in terms of credit growth is going to be quite good. Their net interest margin's still quite low, but I think the growth of credit will increase. So good question. So we've got two models. This model here, the Cape-Shiller ratio, and the Buffett market cap to GDP ratio, suggesting that the market is expensive. We've also got some anecdotal stuff going on in technology land and pre-profit and pre-revenue companies. There is a lot of insanity. This is a company called Snowflake. Snowflake has its year end at the end of January. Its revenue at the end of last January was $265 million. It lost all of that money. It then lost a further $349 million to report a loss of $349 million. When they listed it, they were considering listing it initially at $75 to $85 a share, which, by the way, was 300% higher than the price they'd raised money privately just 6 months earlier. So to think that a company that loses money is worth 3 times more in 6 months is just ridiculous, to say the least. But then it got worse. Not only did they not go with the $75 to $85, there was such high demand for the stock, they raised it to $100 to $110, and then they finally settled on $120 a share, which was 75 times current revenue. The shares on listing nearly doubled, and the company now trades, you can see that dot on the right-hand side. It's about, when I last looked, it was about $265 or thereabouts. It's about 130 times revenue, which is amazing. It's not, this sort of stuff's not only happening in the US, it's happening in Australia as well. So you take Afterpay, for example, it's up 2,500% or 2,500% in 3 years. It's up 8-fold just since March. Its market cap of $27 billion. It makes no money, by the way. It loses money, but its market cap is half of ANZ's, which is unbelievable. It's got a market cap bigger than Cochlear. It's got a market cap bigger than Scentre Group, which owns all the Westfield shopping centres. It's got a market cap bigger than Sydney Airport. If you put BlueScope, Qantas and Lend-Lease together, it's bigger than all of those three, and it still loses money. And it has to raise capital or debt in order to fund its growth. So you're either going to be seeing the balance sheet get more risky because more debt's accumulated, or your equity ownership is going to be diluted by the fact that they have to raise capital. So, you know, it becomes less valuable in the future, not more, and yet the share price has been going up. So there's a lot of funny stuff going on, and because it's been going on for years, it's sort of considered normal. And it makes me think that we're possibly living in a black swan. A black swan, for those of you who don't know, a black swan is something that comes out of left field that was completely unexpected. Nobody in the markets anticipated it. And the reason it's called a black swan is because when the early settlers came, when the first fleet came to Australia and reported black swans, it was something completely unexpected. All swans that they'd ever seen were white in the Northern Hemisphere. And to turn up in Australia and to see black swans was a complete surprise. And so we refer to things that were unexpected as black swans. But given that this has been going on for such a long time, one wonders whether or not we're living and investing inside a black swan, and we can't actually see it because we're in it. So we've got some pretty strong arguments to say the market is expensive, and there's some really odd or unsustainable behaviour going on. There's also the fact that zombie companies are on the rise. Zombie companies are companies that can't afford to pay interest on their debt from their profits. And if we look at that ratio over 3 years, we can actually see on this chart the number of companies that are classed as zombie companies going up. And this is in the Russell 3000. So there's quite an increasing percentage of companies that are zombie companies. And in the US, what they're seeing is the same as what they're seeing in Germany, the UK and France, a rising number of companies that have taken on a lot of debt because interest rates are cheap, but they're unable to pay those debts. And consequently, on the left-hand side, you can see we're seeing a rise in corporate defaults. So companies that are defaulting on their bonds is going up. We can see that big spike on the right-hand side of the left chart. And then on the right-hand side, you can see US corporate bankruptcies are rising, the red line, at the steepest rate of any recent recession. And so that steepening of corporate bankruptcies is something that we keep an eye on. But at the moment, because interest rates are so low and there's nowhere else to invest, the market just doesn't care about this stuff. The stock market's just saying, you know what, that's a problem for another day. Right now, let's just invest in growth, and let's invest in maybe some value stocks as well. And I'll talk about the themes and how to navigate this period. On the flip side, though, so they're all the bearish arguments. On the flip side, what we know historically is that out of deep recessions, the market tends to do really well. So if you look at the median of the market since World War II and after recessions, on average, the market is the red line. You can see it does very, very well coming out of a deep recession. And we are coming out of a very, very deep and steep recession. Interest rates are also very low. And so the present value calculation, so if I were to offer you $10 today or $10 in 10 years' time, you'll take the $10 today. But if you knew that you were going to get $10 in 10 years' time, if that was the question, what would you pay for that $10 today? Well, that depends on the interest rate that you use to discount that $10 back to today. The higher the interest rate, the smaller the amount of money you need to put in today to get $10 in 10 years' time. Therefore, the present value of that $10 is lower when interest rates are higher. But when interest rates are low, you have to put a lot in to get $10 in 10 years' time. In other words, the present value of $10 in the future is higher today. So when interest rates are low, the value of a future dollar goes up. And what's been happening is we've had interest rates decline for 37 years. And so that 37 years of declining interest rates has meant that the present value of future money has been rising. And so everything's been going up. Property's been going up. Share market's been going up. Businesses' values have been going up. So if you're a baby boomer, then you've really benefited from 37 years of declining interest rates. Since you were 30 years of age, it's all been a tailwind for you. It's been really good. And you might think that that's your genius. And yes, there may be some individual genius out there, but you've also had a rising tide of assets that has been fueled by this chart here. 37 years of declining interest rates.
A couple of generations of forever falling interest rates explained? Like, is there reasons to sort of back up why this sort of occurs and what would propel that going forward?
Yeah, what we've seen is declining productivity. So productivity has been actually going down. So take Japan, for example. Their productivity today is the same as where it was in 1994. Yeah. And they've thrown everything but the kitchen sink at their economy to try and get it working. Their problem, of course, is a demographic one. Yeah. And we all are looking down the barrel of Japan in the Western world. We've got aging demographics everywhere. And so we'll all reach the point, whether it's this year, next year, or in 20 years' time, all the Western countries will reach a point where the working population is smaller than the non-working population. And that means productivity would have to be higher for us to be able to keep growing at the same rate, but we're not. Now, Australia's cheated a little bit. The way we've cheated is we've just brought in, since 2007, under Kevin Rudd, his Big Australia policy, we've just brought in lots of people. Yeah. And that's kept our economy growing, but not on a per capita basis. On a per capita basis, our productivity hasn't grown at all. Our GDP per capita is actually lower than where it was before. And so productivity is the issue and an aging demographic. Okay. Now, I think this is a really, really useful way to think about whether or not we're in a bubble. What we want to do is we want to compare the bond rate. Bond rates have been going down, so we want to compare the bond rate to the stock market. Now, we know that investing in bonds, particularly government bonds, is very low risk because the government has the power to tax, and that power is not being taken away from them anytime soon, so they're not going to default on their bonds. And so the bond rate at the moment, the 10-year bond rate in Australia is just less than 1%. If we add on something to invest in the stock market because it's riskier, there's something called the equity market risk premium. if we use 3.5%, and there's a lot of academic debate about what this number should be. Some people say it should be as high as 6%, but a lot of academics are saying it's between 3 and 4%. So let's use 3.5%. If we add those two things together, we get 4.4%. That's the equivalent interest rate that we want from the stock market, or the earnings yield. So if we flip the earnings yield by dividing it into 100, we end up with a PE ratio. The inverse of the earnings yield is the PE ratio. We get 22. And what's interesting is the 1 year forward PE for the S&P ASX 200 is actually about 18 times at the moment. So fair value at current bond rates is about 22. And even if we used 4%, we'd end up with a ratio of, you know, somewhere around 20. So that tells me that, that the market isn't expensive at current bond rates. If you believe the bond yield curve is going to steepen and bond rates are going to go up, well, you need to start bringing this down, and the market maybe is fair value. But at the moment where bond rates are, the market is a little bit better than fair value. It could actually be cheap. And I think that's a really compelling argument. Okay, in terms of navigating this period, deciding on whether, so in terms of the decision about whether or not we're in a bubble, I think there's some anecdotes to suggest there are pockets of bubbles out there. We want to avoid those bubbles, but it's possible the market could actually advance in the next 12 months just from a leadership change, just from those companies that have done poorly in the past. They could do well in the future. And you could generate a great return even in an otherwise expensive market by buying the things that are the cheapest in the market. So those things have been knocked around pretty hard by COVID, for example. So Trump lost the election. That's actually a good thing, as I said earlier, for democracy. Fiscal policy changes, so tax rates originally weren't going to be an issue, but they could be now because of what was announced by Joe Biden's son last night. The vaccine is underway. That's a good thing. A lot of, you know, I was originally worried about anti-vaxxers, but I think you won't be able to travel unless you've had the vaccine. And so that's going to make a lot of anti-vaxxers, that's going to force them to be vaccinated. That'll be good, because if we can get a very significant proportion of the population vaccinated, the virus will probably die out, which would be great. If we can all get them vaccinated quickly enough, all at the same time, then it would be very hard for the virus to spread, and then it would die. Short-term fiscal support is still necessary. So we're going to have supportive monetary policy and supportive fiscal policy. So the government is still going to have to give money to people who haven't bought a house because their wealth is not going up. Trump didn't spend a lot on infrastructure because he was a populist, and there was no point in doing something that might take 4 or 5 years or 6 years to actually see the benefit of. He just wanted anything that was popular for him now. And so the US is probably going to start spending on infrastructure, which will help underpin long-term growth. And interest rates, central banks around the world have indicated, not only indicated, have publicly stated they're expecting to keep rates very low for a long time. All very supportive for the stock market at the moment. Low rates are really good. So particularly for companies that are pre-profit, that are growing into their price, low rates are very good for their share prices. There will also be pressure on pension funds to deliver more income to their investors because interest rates are now close enough to zero. So what I see happening is a lot of mergers and acquisitions, a lot of takeovers by pension funds. So we're going to see a lot of activity on that front. So think about any business that's got a stable income stream, an annuity style income. We could see some takeover offers for those companies next year. If we have a look at what's going on in terms of momentum and growth and value, for example, or companies that lockdown companies versus reopening companies. Peloton is a company that sells stationary bicycles for exercise. Their share price during lockdown went up 600%. Tesla, perhaps because people don't want to catch public transport, they want to buy a car, their share price went up 788%. If we look in Australia, Kogan, online retailers, people locked at home, their bosses not looking over their shoulder at what they're doing. They were online shopping like you wouldn't believe. Share price for Kogan up 553%, but no one's traveling. So Flight Centre's share price down 72%. But recently in November, that's flipped. So Kogan has recently fallen 35% during the reopening rather, and Flight Centre's jumped 26% because of the reopening, or the expectation that a vaccine will mean that we're going to return to normal at some point in the foreseeable future. So I've quoted the Bible there, and it says, the last will be first and the first will be last. We're certainly seeing that in the stock market at the moment. Those that ran really hard during lockdown are being the worst performers in the reopening. And I think that trend's going to continue now for some time, because we are well and truly on the path to reopening. So thinking about the reopening, what are the sort of stocks that might benefit from a reopening? These are some of the stocks that we own in our funds, both in the small caps fund and also in our Montgomery fund and the Montgomery private fund. So they're pretty obvious names. For example, Atlas Arteria, it owns 2,600 kilometres of toll roads in France, or a big stake of those 2,600 kilometres. So as traffic resumes in Europe, as they come out of lockdown, it's going to benefit. You've got Ingenia Communities. Ingenia Communities owns caravan parks and permanent residences in those caravan parks. With international borders restricted, people are travelling more domestically. They're going to benefit. Then you've got a company like Corporate Travel Management, Sydney Airports and Webjet, all in the travel space. They've all bounced enormously. In fact, Webjet was up 65% in November. We were really pleased to own that stock. Sydney Airports, it will come back as well. It's lagged, of course, because international travel hasn't come back, but their cash flow is really stable. It's a critical infrastructure asset, very high quality. Westfield, people told me during lockdown that shopping centres, people would never go back to shopping centres again. They also told me people wouldn't go back to offices again. They're going to work from home forever. You always hear those kinds of things during a crisis. And what I know is people go back to their old behaviours as quickly as they can, and it never changes. So Westfield was sold off. It was priced as if it was going to be devalued by about 30%, or the properties would be devalued by 30%. And they were only devalued by 10. So again, we've benefited significantly there. So that's one of the themes that we think is a good one. Another one is the cloud. Cloud penetration of cloud services, particularly enterprise level cloud services, is only about a quarter at the moment of what it could actually be. So it's a bit like smartphones 10 years ago or laptops about 18 years ago. So there's a lot of penetration left. Now, for those of you who aren't sure what cloud actually is, well, you might remember in the old days when you bought Microsoft Excel or you bought Microsoft Word, you bought it on a disk in a shop. Now you don't. You subscribe to it, and it's housed in the cloud by Microsoft, and you pay an annual license fee. So it's transforming the revenue streams for big companies, and the cloud is also making powerful computing more accessible for smaller companies. And so it's not just streaming music that comes from the cloud or saving your photos to the cloud. It's pretty much everything that a company does or a business does that they used to put on a computer in a rack in their office and pay an IT company to look after it. That's now being outsourced to cloud providers. And so data warehouses are going to become more valuable. Cloud providers are going to become more valuable. Two that we own, or three that we own, are NextDC, Macquarie and Megaport. We think they're terrific businesses, particularly Macquarie Telecom. We think they're going to be very, very valuable because at the moment they're in development phase. They're developing their data centres. They're repurposing a car park to turn it into a $2 billion facility, and that'll be worth $2 billion. But when that's over and they're fully tenanted, and the Australian Taxation Office and ASIC and the government have got their computers housed in Macquarie Telecom centres, and they're already in there in some of their centres, what will happen is they'll have this steady annuity style income stream. And I think what you're going to find is you're going to find a lot of interest in buying that steady income stream. So the value will go up as the company develops its business, but then it could go up another leg, and it could even double just on the valuation of its future income potential. The third theme, and I've got to step up a little bit the pace here so that I can get to that radio interview on time. The third one is e-commerce. Now, e-commerce is a bit on the nose at the moment because we're out of lockdown, and so people's spending at home is sort of slowing down. But longer term, I think e-commerce will do very well. There could be an opportunity here if the shares get cheap enough in the e-commerce space. There could be an opportunity to buy them again for a long-term investment, simply because the penetration of e-commerce is still very low compared to the rest of the world. So if you look at Australia at 11%, it's just on half the developed world average. We're a long way off the UK and the United States. So there's a lot more to go. There's a lot more growth to come as people become used to buying things online. And I suspect you'll see, for example, more people buying Christmas presents online this year than last year, simply because they were at home for so long, they got used to shopping online and they're very comfortable with it now. So there's a whole bunch of companies in this space. We own Redbubble in the Montgomery Fund. We have owned Kogan, Temple & Webster and Adairs. We owned Adairs in the Montgomery Fund. We've sold out of that. Temple & Webster and Kogan we've owned in the Small Companies Fund. We've sold out of those because of the rotation. We rotated early into the reopening trades. We think Lovisa has some great growth ahead of it because they're opening stores in Europe, and they've just made an acquisition which is going to give them a big footprint there to leverage. And if they do as well overseas as they've done in Australia, there's a lot of growth to come there. Okay, when lockdowns are all over, when COVID is a distant memory, conversation is going to turn back towards the climate. And I think electric vehicles are really going to surprise on the upside. So we've seen BMW, Porsche, Mercedes, Volkswagen, all this year launch electric vehicles. And Volkswagen's vehicle is perhaps the most interesting because it's a small to mid-sized soft roader that is priced at about $38,000 US. To put that in perspective, that's a mass market car. So Tesla really had the space to itself, but it was a luxury vehicle and a luxury price point. The competitors are now racing very, very hard to deliver EVs at a price point that everyone can enjoy. And so I think it's going to ramp up very quickly, and that's going to result in a lot of demand for lithium and rare earths. Now, Orocobre and Mineral Resources, they're in the lithium space. At the moment, there is an oversupply of lithium, and that's put pressure on the lithium price. But with the demand for electric vehicles, and I forgot to mention, the biggest market in the world for passenger cars is the United States. And within the United States, the biggest market is California. California are legislating that by 2030, so that's only 10 years' time, or 9 years' time now, in 9 years' time, no new car can be sold unless it's zero emissions. So if the biggest market in the world is going EV, then that means every car manufacturer in the world has to retool to supply EVs. And they're not going to supply EVs and internal combustion engines anymore. They're just going to focus on EVs. We saw in Formula One racing, there was a fallout between Red Bull and Renault. Renault were the engine provider for the Red Bull team. And so Red Bull then turned to Honda to provide their engines. Honda have just pulled out of Formula One completely and said, we're not spending $500 million a year developing engines for Formula One cars when the future is EV. We're going to use that money by developing EV to develop EV engines. So if all the manufacturers in the world that want to sell cars in California are moving to EVs, we're all driving EVs in about 15 years' time. That's going to be huge demand pressure on lithium. And so I think the lithium price will recover, and consequently the share prices for these companies could do very, very well. They've already been going up a lot. If you pull up their share prices, you'll see they've done very well. So that's another theme that I think we'll be talking about in years to come, particularly next year. And the last one is income. Pension funds around the world are desperate to generate yields for their investors, but their international pension funds like the Canadian Teachers Pension Fund, they're happy to provide a much lower yield than what we would accept in Australia. So we price annuity style income streams at 4% or thereabouts, or 4.5%. Those pension funds are happy to give their investors 2% because their investors can only get zero anywhere else. And so they will be very, very happy to pay double what we're willing to pay for some of these assets. So that's why I said earlier, there could be a lot of takeover activity at multiples that are much higher than what we're accustomed to. And evidence of this demand for income is seen in Telstra spinning off its towers because it believes that the market will value those towers more highly than within Telstra. And then the New South Wales government has just indicated that it might sell its gambling taxation revenue stream. That's all a function of the fact that there is massive demand globally for income. And you know the pressure on your own balance sheet and your own lifestyles. You want more income from your investments. So I think next year you want to, or even looking now, you want to look for those businesses with annuity income streams because a lot of them will be taken over. There'll be many takeovers in this space. Okay, our current top 10 small companies listed there. I'm conscious of the fact that we're running out of time, guys, and I'd like to answer a few more of your questions. I've got to be on a radio call in about 15 minutes. So going through some of these companies, you know, we talked about Webjet, Unity Wireless. We think that's a business that's going to be worth an enormous amount of money in 5 or 10 years' time. We think it's structurally going to win from that movement to digitisation. You know, we think Ingenia Communities, talked about them already, that, you know, domestic housing side of things, Mineral Resources, you know, it's a lithium asset. We think that's terrific. I didn't talk about Lynas before. Lynas is interesting. It's a rare earth miner in Australia, in Western Australia. It holds the biggest deposit of rare earths outside China. If you believe that China might restrict the supply of rare earths, and rare earths are what we make those those really strong magnets. So, you know, when your mobile phone vibrates, there's a little device in there that rotates at a very high speed with magnets in it. They're rare earth magnets. And so, you know, China restricts supply to the Western world just because it doesn't like us of rare earths. Then suddenly that Lynas asset becomes, you know, really critical and highly prized. Keep that in mind. And then corporate travel management, we talked about reopening. We think that's an amazing business. 81% of its revenue comes from overseas. And Tyro is your tap and go terminals, your tap and go machine. It's the 5th biggest beyond the banks. It's bigger than the regional banks. And it's got the lowest latency of all the machines. So if you're a pub owner or a gelato owner and you've got big queues for people buying your product, you want to turn them over really quickly. You want a tap and go machine that gives you approval very, very fast. And that's what Tyro has. So I'll finish up there, guys. I know I've got some slides here on the end game. What I'll do is I'll finish up on the last slide and say this. In terms of the end game, what is clear is that the government and central banks don't have an idea of where they're going. No one's talking at the moment about how you pull back stimulus. How do you pull back quantitative easing without causing a recession or depression? How do you pull back all the fiscal spending without causing a recession? How do you pay off your debt that is now at a record high? What happens if creditor nations stop lending to debtor nations? You know, these aren't questions that are being discussed at the moment. Nobody cares about them at the moment, so we don't have to worry about it. But people will care about it, and they will start talking about it next year and the year after. And when it starts being a conversation, expect more volatility to return. In the meantime, I think we've got some really, really positive features, particularly for the sorts of companies we've been talking about today. So I think next year could be a very good year, provided you've thought carefully about the stocks in your portfolio. I'll finish up there. And
thanks, Roger.
Thank everyone for their time. Thank you. Thanks.
Pleasure.
Thanks, Nick.
We have just a couple of quick questions. Is that okay if we just...
Sure, absolutely.
Yeah. First one is in relation to China in particular, trade wars and all the noise being made at the moment.
Yeah.
To what extent will a change in government in the US have an impact on that particular issue, and will it have a positive impact for Australia potentially?
Look, I think there's no doubt that Biden is more of a statesman than Trump, but it's also the case that Trump was the right person for the job of keeping China in check and muscling up, or, you know, beating his chest, much as you might see two pigeons or two seagulls fighting over a twisty. You know, the Chinese, you know, the only way to stop a force is with an equal and opposite force, and Trump was arguably the right person for that job. Biden, as I said, is more of a statesman, more of a diplomat. Having said that, he has come out and said he's not planning on changing any of the policies with respect to China anytime soon. So, you know, we're heading down a path of conflict, and there's no doubt in my mind that the chest beating will ramp up. Xi Jinping only has two levers he can pull in order to remain popular. And one of them is economic prosperity, and that's been challenged this year. And so he's had to pull the other lever, which is vociferous nationalism. And so all of the actions that we're seeing from China is a display it's really a display to generate internal fervor around nationalistic pride. Because if he's seen to be putting the West in their box, seen to be putting Australia in its place, and preparing for some sort of conflict and doing it with confidence, that makes him popular in China. And so we're going to see more of that. And that means potential for volatility. Yeah. But I think we're still a long way off a conflict. And Germany have just sent a frigate actually to the South China Sea, which tells you that the European group of nations is now backing the US's plan to take China on and check their expansion plans.
So in the short term, those companies that are dependent on Chinese exports, particularly the commodities sector, is there anything to be worried about in the short term?
No, I don't think we have to worry about iron ore. They're pretty dependent on our iron ore. Having said that, though, if you think about chess moves, let's say we decided, this is hypothetical, of course, and not going to happen, but let's say we said to China, you know what, we don't like you either. We're not going to sell you any of our iron ore. Well, China would say, that's fine. We're never going to buy it from you again. Yeah. And so, that would be a loss to us. So we won't do it. We'll continue to supply iron ore to China. We are therefore dependent on them. But if they want cheap iron ore, they need to keep all the markets supplied with cash. So they need to buy from all of us, including Australia.
And one final question, Roger. In the next 12 months, immigration or lack thereof of both temporary and permanent migrants, what could that mean for the domestic share market?
Yeah, I don't think migration matters that much to the share market. It does matter a lot to the property market. And in fact, I said earlier that you might remember, I said earlier, the single most important driver of property prices in the short and medium term is access to credit or credit supply. And loosening of credit, house prices go up. Tightening of credit, house prices go down. In the long term, though, the single most important factor is migration. But I don't think we've got a long-term migration issue. We've only got a short-term migration issue. Migration will come back. Secondly, what's been forgotten is that, yes, we're not getting 240,000 migrants coming to Australia this year, but there are 385,000 expats that want to move home. And so that could be a support that offsets the short-term decline in migration for property prices.
Yeah. Well, we're just right on time. Thank you, Roger. We'll let you get off to your next appointment. We're very appreciative for your time here today. Some fantastic insights for everyone who's joined today's session, and all our clients who invest money with you as well, of course. So thanks very much, and hope you have a Merry Christmas, and we look forward to perhaps seeing you again with us sometime in the future.
Thanks, Nick. A happy Christmas to you and Christine, and a happy Christmas to everyone else. I do hope you have a safe and peaceful one, and a prosperous 2021.
Thanks very much, and thanks to you all for attending today. We'll see you all very soon.
Thank you.
Thank you.